Good afternoon. Peter Klein, Chief Investment Officer, founder of ALINE Wealth, here with you in this August afternoon in the summer of 2022. I'd like to share with you some of our thinking as it respects with respect to inflation. And to do so, to frame this discussion, allow me to start this story in the year of my birth, 1965. And it's my view that that was where we started to see the kindling or the sparks that led to the major inflationary period to what we saw in the 70s. And more we saw of that, that kindling, that beginning started through the Vietnam War spending. Then we had LBJ's Great Society spending. And the combination of these two, coupled with Arthur Burns, the then Fed chief, he was very ineffectual, start and stop with respect to trying to push down inflation, and he was ineffectual, and it didn't work. And then you had, of course, the OPEC and the oil embargo, and that massive increase in oil and energy costs that led to the real hyperinflation in the late 70s. So there was a roadmap there. And so now comes Ron Reagan, right? 1980, he's elected president. He has a mandate for change. He's got the political capital to make some difficult decisions. And he taps the 6'7" Paul Volcker, a cigar-smoking giant that comes to the Fed, and he's going to change the way inflation is running, and he's going to snap it and put it to bed. And at the time, we were looking at double-digit inflation and interest rates. He began to raise them, and in the early 1980s, 81, 82, we're looking at interest rates on CDs. Can you imagine CD interest rates in the 15, 16, 17%? And it would give you a free toaster as well. I remember my grandparents telling us how they put our college money aside in CDs, and amazing, and how kind of rate of return they were getting. But of course, inflation was very high, and these high interest rates. To those of you who had a mortgage back then, you remember those double-digit interest rates. They started coming down because they were so high. Volcker raised them so high that he began to stamp out inflation. But he also caused two recessions, one pretty nasty one in its wake. So not the easiest of prescriptions, but certainly did begin to see the inflationary overtones of the economy lessen and mitigate. But in my view, it wasn't just Paul Volcker's monetary machinations that caused the disinflation that we were to see for the next 40 years. There was a confluence of events that's unlikely to ever see it again, that really led to the disinflation that caused the interest rates to come down for so long. First, you had the opening of the emerging markets, right? Early 80s, China and India, they weren't viable. They began to become viable at that point. And we saw that the developed world outsourced inflation to these countries because they could produce so much less expensively than we could in our own countries: Mexico, China, India, Bangladesh, the rest of the emerging markets. So that was a major disinflationary event. Number two, women and immigration. The increased supply of workers decreased the cost of workers. Number three, so that was disinflationary. Number three, technology. Could you imagine the differential in productivity from 1980 to 1990 to 2000? I mean, dramatic increase in productivity. That's disinflationary, as is, of course, just-in-time inventory and running your businesses in a technology-forward way. Very disinflationary. And finally, we had, towards the latter end of the decade of the 80s, we had the fall of the Soviet Union. And many folks don't realize that right before the fall, the former communists, in order to raise money, they flooded the world with oil, which caused, again, disinflation. So there was a setup there, and it was perfect. It was great. The stars aligned, first with Volcker and then with these circumstances. And it was a wonderful 40-year run. When the price of money when interest rates, folks, when the price, that's what interest rates are, the price of money. When those keep falling for 40 years, lots of good things can happen, right? The wind is at the proverbial back of M&A investors, they develop asset bubbles. Consumers buy a bigger house, less mortgage. They spend more, 0% financing. The Fed's accommodative. The Fed put, right? Don't worry about the markets, investors. We'll just lower interest rates again. That's the scenario which we've been living under for the last 40 years. And again, a lot of problems, a lot of mistakes get swept under the proverbial rug. Values go up, private equity is on the ascent. Things become very, pro-capitalistic because of the fact that price of money gets lower and lower. Well, we see a regime change, and no longer will we have that tailwind of disinflation and, of course, and lower interest rates. In fact, we may very well have the opposite. Now, in part due to COVID in 2020 and the war in Ukraine in 2022, of course, the COVID and the spending the governments around the world did. When you see M2 jump as much as it has, that takes time to work through the economy. That is inflationary. More money flooding into the economy globally, right? Of course, in the Ukraine, the awful war that we've been seeing there, very inflationary from a food and energy perspective. As we know, Ukraine is a large producer of wheat and other food items, and of course, Russia with the oil. So a lot of issues now are coming to the forefront. But it's not just those two circumstances. It's also the fact that we have labor. We have changes in labor. And maybe this started back in after the great financial crisis with the Occupy Wall Street movement and the populism that came from that. But labor is on the ascendancy, right? We're seeing more and more unionization. Look at Amazon and Starbucks. Both went union, right? So labor now has a bit more control for the first time in years, and then demanding a bigger slice of the pie. An interesting quip. I was on the Long Island Railroad a few weeks ago. Lovely young couple sitting across the aisle from me. The fellow gets off and he waves to his wife, and she says to him, "Don't work too hard. They're not paying you enough." Which is really interesting because it speaks to this change of behavior. And again, I'm not saying it's bad or good. I'm simply observing it. And the observation is they have more labor has more power and therefore inflationary, which is interesting. Now, there's also one of the bigger portions of this potential increasing of, or I should say, stubborn inflation is the ESG and net zero movement to save the planet. We've got to save the planet. There's no doubt, clearly there are issues out there, and clearly we have to fix those issues globally, but they come with a price, and the price is inflation. And so if you look at important green metals like copper and nickel and lithium, it's estimated by the IEA that we will spend $5 trillion annually for the next 30 years. And it's probably going to go higher than that. That's $150 trillion to get green, to get us off of fossil fuels. That's not going to happen overnight. No way. It's going to take a lot of time. And I think the price of that, the price that we as citizens around the world have to pay is stubbornly high inflation. And so we see that as being, and the reason for this is simple. There's been no CapEx spending for years, no new copper mines, no new aluminum smelters. Why would there be? They were in the crosshairs of the ESG movement. So they said, all right, we'll just milk the cow and not go out and find new cows. And so this kind of thinking has led to the dearth of supply that we now find ourselves in. And therefore, when you have increasing demand and supply constraints, well, guess what? Prices always go up. So You know, how do we make money in this stagflationary environment where we have slow, low growth with stubbornly high inflation and to some extent higher interest rates, which is a pushback from what we've been used to for the last 40 years? Well, you know what? There is a playbook, and that playbook is one to which can be very beneficial to investors today. We're excited about it because while it's different than the last 40 years where you could just throw a dart against a wall, and we see this new playbook as one that's returning to good old financial analysis, value investing, right? Where the numbers count, not just the story or the momentum, but like it did in the 1970s. Who made money in the 1970s? Buffett did. Warren Buffett and his value brethren did very well. Why? Because they shunned the overvalued high multiple nifty 50 stocks, and they focused on value and resource companies that they were able to buy on the cheap. And that's why they did so very well. And I think we're going back to that kind of environment where value investing will be a bigger force going forward. I guess it's sort of like, I'm dating myself now, but it's sort of like there was a TV show back 20 years, 25 years ago on Channel 13. That gives you an idea, PBS, on Friday nights called Wall Street with Louis Rukeyser. There still is a great program by that name, but Louis Rukeyser has since passed. And this guy Rukeyser was boring. I mean, it was like, my wife would like paint dry, but I liked it. And it was just, a stoic, analytical, skeptical of hubristic pundits kind of thinking, It was like, here are the numbers, here's the analysis, here's why we should look at this, and let's be skeptical of what could go wrong. That kind of market sentiment is likely to be ushered in. But the good news is, if you have the playbook set and you understand what's coming down the road, you could allocate capital effectively through companies and sectors that have pricing power, companies and sectors that have the ability to grow, asset-light industries, right, where they're not spending so much of your capital to grow. So this is where we see opportunities, and both here and abroad. And we welcome further conversations about this. So please reach out. Love to discuss this further with you. But let it be said that we believe we're in a new regime, and one that will be very interesting and very different than the last 40 years. Okay, folks, talk to you soon. Thank you.